Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
All right, everyone. Welcome to the show today. We're going to stay firmly focused on trying to get an understanding of this property market that we're in right now. If you've been tuning in to the Smart Property Investment Show over the last couple of weeks, months, you see a bit of a theme is developing. We've been trying to explore all these different drivers within our property markets and trying to synthesise some of the noise coming out of the media, albeit often, I don't know how sensible some of the commentary coming out is, but we've been pulling people in from all over the place who know what they're doing in their particular domain, and I've enjoyed a lot of the conversations that I've been having with demographers, economists, and just people who work across the property industry. The message to me, and pretty much by and large, every single person I've spoken to on the Smart Property Investment Show, and go and tune into it, they're all pretty bullish about the property market. Yes, there are some changes to property markets, but if you invest in property for a little while, you know that property moves in cycles, and right now we're just in a cycle. It's a cycle that's here, and it's a cycle that is going to be a cycle for the next period of time, but things do move up and down, left and right, sideways, whichever way it is. So I'm very confident, having spoken with a number of people right across this property game, stay the course, no need for panic. There's opportunities in this market, and like myself, if you're a property investor, I'd be looking at how you can capitalise on what may be a period of time where you can really supercharge your portfolio. Today, I'm going to approach this conversation, this dialogue, from a bit of a different angle. I have in the studio today from the HIA, which is the Housing Industry Association, their principal economist, Tim Reardon, and we're going to have a chat about what's going on with property, population dynamics, building approvals, and everything else to hopefully give you some greater sense and clarity about the property market. Tim, how you going?
I'm very well, thank you. Thank you for having me.
You've been in this game for a little while.
Yeah, been around, certainly in Canberra, doing economics for the last 20 years. This is my second stint with the housing industry. I've been with the HIA now for about 18 months on this cycle, and was with HIA back in the glory days prior to 2007.
Okay. So what does the HIA do for our listeners that don't know?
Housing Industry Association, we have 40,000 members nationwide, mostly your mum and dad type builders. So I think the Hilux ute with the green and gold sticker on the back of it. And we provide advice, support and services to those. We also, in HIA Economics, we provide a 4-year forecast to tell them how many homes they're going to build over the next 4 years, and we do that down to the local council area level as well.
Okay, so there's a number of ways we can look at the dynamics of this particular market, but I'll go this way first of all. Are tradies, home builders, people working in the building game, sitting around with their heads in their hands saying the sky's falling in?
Well, in certain parts of the country they are. If you ask a builder in WA, it has, and it is the deepest and most sustained downturn they've ever had. If you look at parts of the Sydney market, you'll find that they've got some bad times occurring at the moment. But when we look at the macro numbers, no. The last 4 years have been a boom of enormous proportions. So traditionally we'd build between 130 and 180,000 homes per year. And in 2016, we cracked 233 homes per year. So that's 20 to 30% above the long-term average. So the fact that we're now coming down off that, and we're down sort of 7 or 8% off the peak of 2016, and we're looking at that going forward for the next 2 or 3 years, it's going to keep coming down, possibly in the ballpark of 20 to 25% as our forecast. Now, normally that would be the end of the world for us, but in this cycle, that's going to mean the downturn, the bottom of this cyclical downturn, is going to be higher than any of our previous peaks.
So more stuff is getting built at the bottom of this curve versus any other time at the peak.
That's right.
Okay.
Now, there is a little bit of difference. Our membership and across the market, traditionally the market was dominated by detached houses. So until 2009, around about 7 to 9% of the market was apartments. And at the moment, around about 30% of the market is apartments. If you look at a market like the ACT, 70% of that market at the moment is apartments, only 30% is detached houses. So there's been a material change. And that change has come about largely because of planning regulations allowing apartments to be built. So what Sydney saw that dark period in the 2000s where Sydney is full, and that constraint on planning, or from planning, that didn't allow high-rise apartments to be constructed. Similar things happen in Melbourne, and what we've seen is that pent-up demand is now being met. The loosening of those restrictions on high-rise apartments has meant we've seen a boom in the development, so playing both catch-up and also meeting the current demand. And in some markets, you could possibly argue getting a little bit ahead of that market, and that's one that people particularly highlight in the case of Brisbane. But what we're seeing is that Melbourne, 2.3% population growth. That is astounding. And whilst ever that population growth is sustained above 2%, then really the industry is not going to be able to outbuild that population growth. That's going to keep soaking up and absorbing any level of building activity that occurs. Now, that population growth is dependent on a whole range of things, which includes a variety of different government policy decisions, tax, population growth or net overseas migration, but also jobs. And so Melbourne has had very strong employment growth. It has had an exceptionally strong economy for the past 4 or 5 years, and it's been sucking in workers from the rest of the country. They picked up just about every worker that left WA after the mining boom was drawn to Melbourne. We're now seeing WA starting to maybe draw a couple of those back. They sucked everyone from southeast corner of Queensland, and we're now seeing that trend reverse. We're seeing people move back up out of Melbourne, back up to the southeast corner. So that trend of very strong growth in Melbourne and the apartment market's going to begin to cool, and as similarly we're going to see in Sydney, and it reflects pent-up demand being met and simply just that there is a record volume of new homes that are meeting for the first time in at least 2 decades. The market is meeting the demand for new homes.
So one of the metrics and mechanisms for how you look at the market is how many homes are being built, whether they're houses or units. So let's call them homes. Is the activity in home building a product of the market, or is the fact of the activity happening in home building and construction influencing the market? Is it, tail wagging a dog type of thing?
Yeah, no, it certainly goes both ways around. Yeah. So, the fall in house prices we've seen in Sydney and Melbourne, 6 or 7% in Sydney, 4% in Melbourne, both of those are at least in part as a consequence of record volume of home building. Okay. Now, when we're looking at home building and how much demand is going to change, we don't look so much at price because it's not a great indicator, because it is significantly affected by other factors such as government policy decisions and planning schemes. What we look at is rental prices.
Okay.
And what we saw this last quarter to June 2018 is, for the first time since 1994, rental price inflation went to zero. Now, 1994 is not a coincidence, because 1994 was the last time we hit a record peak in building activity. Okay. So that means for the first time in that time frame, we're now at the point where supply and demand are at equilibrium. So if you look back just to 2015, where we saw 17.5% increase in house prices in Sydney, that was in part because of all of the pent-up demand of the 90s and the 2000s where supply was restricted. Entering the market and absorbing the housing stock that was there, that we've now met that housing stock demand, which is why we expect to pull back from the 233 starts per year back to 187,000 new homes being built per year, which is still, for the building industry, a very good year in any year up until 2014. It does mean for our members, for the home builders, they're going to see a few years where they begin to see their level of activity contract. That becomes a particular problem in Melbourne, and we talk about this with our members. So what's happened in Melbourne is that new residential developments were in the southeast, and the next lot of residential land that's become available is in the northwest. And so those homes now, builders are shifting their tradies from working in the southeast corner to the northwest. That has a cost implication for them.
Okay.
We're seeing timber prices going up, cement prices going up, costs of building homes going up. And we're seeing, because of that volume of homes, we're seeing a cap. Price growth isn't going up as fast as what it has over the past 20 years. And that places them in a difficult situation, in that they could still be building a record volume of homes, but finding that the only bit that's left in the middle, which is their builder's margin, is getting squeezed.
Yeah. I was going to ask about the builder's margin, because if you're not that familiar with how builders work, for many builders, it can be feast and famine. They'll be super busy, plenty of jobs on, good pipeline of work, and then what typically happens is that markets change or their business development changes, and they end up with a whole bunch of tradies and skilled tradespeople they've got to pay, but there's no work coming online. So, you need to be very conscious, and not really today's podcast, but conscious about the type of builder you're using to build your property, your investment properties, but we'll put that aside. The tradies, the builders in today's marketplace, you're talking about the shifting dynamics of trends and locations, and when builders' margins getting squeezed, their ability and capability to keep building is compromised, and therefore that might influence, the ability for starting. You're saying they're coming down quite a lot. Well, comparatively coming down from where they used to be. Do you think you're going to get an exodus of builders in this marketplace, or is enough being done to actually prepare ourselves for the next range of growth? So we've got the people who are there to support increased population. And I know your game is essentially population, and if there's more population coming in and they need housing, we need builders.
Yeah, well, I'll come to population in a moment, but in terms of builders, the average Victorian builder would have close to 2 years worth of work on their books that they're going to build. So Pre-booked. Okay. So they're all right for the next 2 years. We're talking a little further out than that. Sydney, the market's tightened up. They're probably 12 months ahead, so they've probably got a year's worth of work on their books before things start tightening up. But tomorrow we'll have a report out on trades and trades availability. And what it shows, not surprisingly, is that trades are still in relative short supply. So there are, even if we come back another 5 or 10%, we're still going to see that there is a need for more tradespeople than what are available in the market. And as a consequence, their prices continuing to go up. But the rate at which that skill shortage exists and the rate at which their prices are going up has fallen back from what it was a couple of years ago, which is simply reflecting, we've gone from 230,000 starts per year to 215,000 starts per year. Interesting, but shrug your shoulders.
There's enough work around. So we've gone through Australia as what a great place to live, outside of it being beautiful.
28 years of continuous economic
land of milk
growth.
and honey, all this sort of stuff.
Land of milk and honey.
Which is great. And there's some challenges with that. This generation coming through right now, I've never really seen a tough time. I'm a sort of a younger generation Xer, and I remember when I was a kid, my mother paying interest rates at exorbitant amounts, it was a lot tougher, right?
Yeah.
It's a lot better. We've had nearly 30 years of really good times, driven by and large by a number of cyclical booms, whether it's mining or whatever. Property is the backbone. Mortgage financing, property is the backbone of our economy. We have a strong property market. We're fortunate that we've got strong banking institutions and supported, some would argue, by some reasonable sort of policymakers in there. Things are sort of mixing up. They're changing right at the moment. I was seeing a piece on someone on the news the other day talking about, this property crash has always been predicted, and we're in a depth of it right now, which I do not subscribe to, right?
Yeah.
What's going on with the market? Are we going to get another 10 years plus of solid growth in Australia? How do we do it?
Yeah, so how do we go from 30 years of continuous economic growth to 40 years of continuous economic growth? Well, the only way we're going to do that is in spite of our politicians, not because of them. The pathway they have set forward us at the moment isn't a particularly strong one. But in terms of what's going on in the market at the moment and houses, it is a cyclical downturn that has been well foreseen. It's not a structural downturn, and with all cycles, the housing market's like all others. It goes up and down. The mistake that every market investor in every market does is to assume that the good years are going to go on forever, and of course they don't. Yeah, in terms of getting to 40 years of continuous economic growth, if you look at, the 80s was about macroeconomic reform. We floated the dollar and reduced tariffs. And the 90s was microeconomic reform, where we had the Hilmer reviews. Then the 2000s was budget repair with Howard balancing the budget. We hit the GFC, we cruised on through. And in that time, we also had some fortuitous wins. So Chinese resources boom from 2003, which led to employment growth, which led to a population boom post-2007, which has led to a housing boom, which drove our economy for the next wave. And the question's, what's the next one? And the answer to that is the one that we've got at the moment, you can see it very evidently when you're in Sydney, is an investment from governments in public infrastructure. And that is going to continue to drive jobs growth in Sydney, Melbourne, and most other capital cities for the next couple of years. So I'd expect that will keep our path of continuous economic growth going. Whether it's sufficient to get us to 40 years, well, it's not sufficient to get us to 40 years of economic growth. We're going to need a few fundamentals fixed. Post the GFC, the rest of the world played a game of attracting investment into their respective economies. The United States, and you can see it at the moment too with Trump's nationalism, trying to attract investment. His tax plan, for all of you can criticise him for, his tax plan is going to see Apple return $200 billion worth of investment that they're holding in offshore bank accounts back into the United States to spend on creating jobs in Apple. Now, $200 billion
it goes a long way.
Yeah, well, that's roughly the same as the Australian federal government. You're creating an entire Australian government just from what Apple are bringing back. So And Australia hasn't played that game for the past 10 years. We have not been attracting investment into the economy. We've lost our manufacturing base. We lost our automotive base. The exchange rate in 2012 burnt a lot of investors. And we're not seeing large-scale investment, partly due to price of energy prices and the very little that we're going to see in the near future, which is going to see those return to internationally competitive prices. So you put all of that together, then we're still very dependent on coal and iron ore. To a lesser extent, the tourism is a good news story, 6% growth per year. But when you look at that growth, it's coming almost exclusively out of China. And if you look at the rate at which the Chinese are going on holidays outside of China, Australia's not attracting its fair share. So we're not winning more than half of that market. We're winning less than half of that market. And you look at our traditional tourism places, Cairns, I was up there recently looking at building activity there, and 4% growth in tourism dollars you'd think as being positive, but national average is 6%. So there's education is another pillar that we have holding us up. And that comes about largely because of policies introduced under Howard era 2003 onwards, and it sits third really when you look at our income streams from overseas, behind coal and iron ore as our major income earner. And it also is starting to shrink. It's shrinking partly because of government policy restricting visas. So Howard set up the migration two-step where skilled migrants would come to Australia, pay as a full fees-paying student, get a visa to study, and then once they'd completed that degree, they'd stay on as permanent residents. And when we're forecasting building activity, population, that's how we determine what building activity is going to be in the future. And those skilled migrants are really the core of what you need in order to grow economic activity and what we look for when we're forecasting building activity. And so changes to visas that came into place in April of last year have started to see a restriction in skilled migrants. We also so that's a structural change. Yeah. We've also seen a cyclical change. So the United States, the UK, a number of EU countries as well saw what Howard did with the migration two-step, and they've mirrored it. So every other country in the world is now competing with us to attract those
students in.
Exactly. So we were, post-GFC, we're the only developed economy that had very strong employment growth at that period of time, so we were attracting all of the world's skilled migrants. But now we have other competitors in the market. The US, as it picks up pace, and it now has low unemployment levels as well, growing employment levels. So we're going to face tougher competition for attracting skilled migrants, tougher competition to attract investment in new manufacturing, mining, other industrial activities that create those employment bases in cities such as Sydney and Melbourne that they need in order to be able to sustain economic downturns. And on that, we've seen now a situation in Australia where 1 in 10 people, because of the housing boom and because of the boom in government expenditure on infrastructure, that 1 in 10 Australians are now employed in the construction industry.
Is it that much? Is it?
Now, that's happened before. Usually happens in a recession, and construction's the only bit that continues on or remains relatively strong. But we're seeing it this time at a time when the economy is at 3% growth and 2% inflation and 5% unemployment. They're very good macroeconomic. Yeah, and so it's also really the first time that Victoria has ever seen 1 in 10 people employed in the construction sector, and they have that now. The reason they have that is because they have lost their manufacturing base they used to be the manufacturing state, and that drop down in employment in manufacturing has been picked up with employment in construction. So as we see that dip down in construction that we're expecting in residential home building and eventually then in public infrastructure, there is a challenge there for state governments and the federal government to be able to attract investment into other equivalent manufacturing industrial businesses to be able to sustain those levels of employment to get us to 40 years of continuous economic growth.
So we can hit it.
It can be done,
but
absolutely.
The government, state and federal, has a big part to play in that. So let's touch on that really quickly. Your people down in Canberra who are rattling the doors of ministers and senators, sort of advocating, lobbying, whatever you want to call it. What are you trying to communicate to Morrison government? And then should we get a change of government, What are you guys saying to these people who make policies?
Right at the moment, it's about retaining the investors that we have. So those building product manufacturers that we have that producing a whole range of, whether it's metal-based products. We've got Ream just down the road here in Sydney. There's CSR, there's Boral, there's Brickworks, those large manufacturers. All of them could switch and start importing product from overseas. But we have those manufacturers here and we should retain them. Once you've lost them, they are much harder to get back than they are to retain. So, they're facing, when they do their international benchmarking, they are facing some of, if not the highest energy costs amongst their talent pool. And so that makes it very difficult for them to seek from their parent body, investment to continue to grow their business or seek to expand on an export basis or to reinvest in new capital infrastructure. And so that's the primary challenge. The secondary challenge is then to attract new investors into the market. Now, that was really impossible when we had the exchange rate at $1.10, but the exchange rate now at,
a bit more favourable.
Yes, that's right, but back closer to long-term levels. Then, those dynamics should play to Australia's favour. We have, the inherent abundance then of skilled workforce, resources and availability of other essentials to be able to attract that investment.
So the cost of power in Australia is just not the us turning on the air conditioning or the heater over winter and being warm. It inherently links all facets of our economy. The fact that our power is not competitively priced.
Yes. To give you another, it actually works in a very similar way to a rise in interest rates, in that you increase electricity prices and households have less money, which is the same as what happens when the Reserve Bank raises interest rates, and it constrains businesses' employment decisions, and therefore you get almost a mirror image. So 1.5% cash rate, which is probably going to continue for as far away as we can forecast, and it is in part because electricity prices have been doing the heavy lifting for the Reserve Bank on constraining inflationary pressures. It took 20 years of mismanagement to get to this point with energy prices, and it was likely to take just as long to get us back to having competitive energy prices.
So it's not an issue that's going to go away tomorrow?
No. The sunk investment by state electricity businesses in poles and wires, the carbon debate, we'll call it that, for the past 10 years and the impact it's had on investment and generation, those two issues are going to take a long time to play through.
So outside of electricity price and how that's shaping both micro and macroeconomic forces in Australia and our ability to attract investment, which we just covered, population growth is one of the key drivers of supply and demand, whether it's building new properties to house our growing population or it's the trade in existing properties. Population growth is going to be a big determinant on whether or not the speed at which this current market levels of, or some would say it's normal now, but get to a period back into growth. Our population is going to keep growing.
Yep.
What needs to happen for it to grow at a speed in which it benefits all those things you spoke about?
So just a quick little bit of history. So, we clocked up 25 million people just a
couple
little
of months ago, I think.
Yeah, that's right. So 25 million people. By way of comparison, 1983, Australia and Malaysia both had 14 million people. Malaysia's now 32 million people.
Okay.
Australia's 25 million people. And we're plugging away at quite a fast rate, growing quite quickly. And the next country we're likely to overtake on that league table of most populous nations is North Korea.
Okay.
North Korea is a country the size or half the size of Victoria, and they don't have coal or iron ore. So
They have the most submarines in the world, though.
Do they?
There's a bit of a tidbit, yeah. That might not be that good, but anyway.
Yeah, we don't have too many submarines, I guess.
No, we don't. Yeah, we get some new ones, but they got a lot anyway.
Yeah. And so then you're talking about the 80s and 90s there. You go back to the recession we had to have, and population growth at that point got back to around about 0.3, 0.4%. And there were some pretty dark times there for everyone involved. Melbourne at the moment, 2.3% population growth. That is
huge.
That is, and Sydney also 1.5, 1.6% population growth. So they are very strong. And for all those reasons we cited, Australia's ability to attract overseas migrants from both an employment perspective and from a visa perspective has been quite positive. And so seeing population growth pull back as we have at this stage from a peak of 1.6% around a year ago back to about 1.57% at this stage, that's interesting, and that's one we follow very closely. But at this stage, it's a little like the down cycle in building activity. You're going from a record high back to a pretty good number, back to a more sustainable
number. And sustainability is everything we want.
Yeah. And from a population perspective, from the industry perspective, what we don't want is rapid changes. We need consistency in government policy around population growth. So what we're seeing at the moment, an announcement this morning, the New South Wales government's going to have a look at population growth in Sydney, and there was mention by the Premier of halving the net overseas migration. That's the worst case scenario for the building activity, because that's structural problems. The government pulling their policy levers and trying to swing the building industry from one way to the other. That's a problem for us. What we need is a more sustainable, long-term approach to population growth.
What's your read? I just started thinking about this now, but what's your read on how overseas migration supports the building industry in that culturally? Is it the propensity of people who choose Australia as their new home to buy new rather than existing, or is it largely irrelevant?
Oh, that's a good one. What I can tell you is that the changing demographic in Australian population has led to a change in the type of house we build. So switching from detached houses to townhouses to apartments.
More vertical living or high density living, which is reflective of people coming out of Asia, for example.
Exactly.
Yeah.
I'm not sure I could go that far. I don't think I have any data to support that one. But anecdotally, that would seem to make sense.
It would make sense, right?
Yeah.
But so you're a property investor. You invest in property yourself to move into. But we talk a lot, Tim,
best store of wealth. Yes.
It is the best store of wealth. It's where I try and park a lot of my wealth, and one of the big things on the show here is that one of our portfolios, we share how we grow and evolve and what we're buying and how we're doing it and how we see the world and stuff. So I'm really fortunate that I get to chat to people like you who know what they're talking about, and it's sort of the best sort of free education ever. But you've got a pretty diversified portfolio. I hear my people tell me that outside of property, you also your diversified investment into gin distilleries.
Yeah,
What's going on there?
Yeah. So only licensed distillery on a residential block in Australia, and I did successfully negatively gear it for a couple of years, but the last 12 months it switched itself over to a positively geared business, which has been a lot of fun.
So you're paying tax on it now?
Yeah, I am.
You've got to contribute. Well, why is that? You're selling plenty of gin, eh? Is that the idea?
It's been a good couple of years for the gin business, yes.
Who's buying gin? Just all and sundry? I know you're a demographics guy. You must have. I reckon if I went to, I'm viewing a shed somewhere on some property somewhere.
Yeah, that's what it is.
You got charts and maps all over there about the evolution of.
So our customer base 83% female.
Okay.
Yeah, that blew me away. So our branding, our labels are very masculine label, and as soon as I learnt that, which was a little bit of a surprise, we switched branding a little bit and have gone a little bit more feminine in recent years. And two age spikes, one's 35 and one's 55.
Okay.
And that reflects both the gin and the vodka market. Rum and whiskey we're starting on in the near future, and I'm sure that'll bring our demographics back to
what's the name?
more
What's the name of your
the Canberra Distillery from Canberra?
Oh, there you go.
Yeah. So a range of gins and liqueurs and schnapps and
madness.
Yes.
Yeah. You must use a lot of your skills analysing data and trends to try and work out how you can. It's not really a fledgling industry anymore, is it? Gin it's really gained popularity over the last couple of years. Right?
No, it's still an infant industry because it hasn't gone through that cycle. So, Porter's model of market equilibrium, that cycle that every industry goes through, the peaks and troughs. The tulip cycle, the South Seas crisis cycle. That cycle plays out for every commodity, and it will play out for gin industry as well. So we're seeing a proliferation and growth of number of gin distillers. And as you grow up that curve, the number of gin distillers and the number of products available will exceed the growth in terms of the number of customers, and then you get that contraction.
What's the correlation between property markets and building approvals versus gin sales?
Look, if we look long
we
enough,
get a bit off tangent here.
If we look long enough, we'll find a correlation.
Yeah, it must be.
Yeah. I'll get into that one. Yep.
That's really. I just want to touch on it. What's sort of rental prices at the moment? So, what tenants pay for rents is intrinsically linked with all these different dynamics we've spoken about, and we've sort of we cover quite a lot really quickly. We're talking about some pretty deep economic fundamentals here, and go and check out smartpropertyinvestment.com because we do discuss these. If any of these terms that we're using you're not too familiar with, but what's happening with rents is typically an indicator also of building approvals and market dynamics. What are you seeing? What are you guys seeing?
Yeah, so rental prices in metropolitan cities have come back. Sydney and Melbourne going to zero, which is or very close to zero, which from our perspective is that's not a bad thing. That just tells us that we've reached that equilibrium, which is a good outcome. Going ahead, you'd expect that the rate of rental price inflation is not going to be as great in the decade ahead as what it has been in the decade past, and that's because as that supply of record volume of homes for the last 5 years flows through into the economy, that they will keep the supply and demand balance will be suppressed more than it was in the preceding decade.
So I just got off the phone just before we come to this podcast from one of my agents out in the western suburbs of Sydney who's got sort of 4 or 5 month property. She went, Phil, all your rents, they're at market or they're not going to do anything. Let's just leave them as they are right now. And so there is less demand at the moment for rental accommodation, but I think a lot of it can be led to, or you probably draw some parallels with increase of first-home buyers who like to buy new stuff. What's the government doing in terms of incentives? Because there's a lot of first-time investors, right? Incentives around getting more first-time buyers in the market, because it always ebbs and changes, different state on state, but you still get some incentives when you buy new stuff, right? Is that how it works?
Yeah, so New South Wales and Victoria both had new first-home buyer incentives in July last year, and we've seen a bounce in first-home buyer activity in the market from about 11.5-12% to about 15.5%. The other factor that's driving that is that the government intervention in the market to constrain investors.
Yeah.
And I think you've probably talked about that.
Quite a lot.
Yeah. So, there's the APRA restrictions, state government stamp duty restrictions, all of those. We've seen about $3 or $4 billion worth of investor activity exit the market. The bit that we can't measure is that the Chinese government also put constraints on the outflow of investment out of China, which is restricted investment. And the big one that my members complain about at the moment, which is a very real dynamic, started in March this year, which is the banks constraining borrowers and the amount of money that they will lend them. Yeah. And I think Robert Gottliebsen wrote an excellent piece in The Australian early this week, which covers the topic really quite well. And so it's in part a response to falling house prices, in part a response to the Banking Royal Commission, but they're simply restricting borrowers, particularly first-home buyers, on the amount of money they'll lend them, which is causing house prices to come back a little bit. Now, it's a cycle. It'll play through for 12 or 18 months. It started in Sydney in March, and it's now a significant problem in Perth, so it's flowed all the way across the country. The first phase of it is that the banks audit every mortgage broker in the city, which means for a month there, no one can meet with a mortgage broker. And then the next thing is that first-home buyers find they can borrow $100,000 less than they could last year. Yeah. And that's just tightening up the market. So we've not complained about that because every aspect of the residential home market has been built on having a stable banking system. And we saw Fannie Mae, Freddie Mac, 2000, GFC, that it was lending to for homes that was the precursor to the GFC. And so from that perspective, having a stable banking system is extremely important to the housing industry.
We're extremely fortunate that we have that, and also a lot of Australians have a lot of their wealth tied up in the banks as well, and their super funds. So, we need a strong banking system. I'll close with this, Tim. Change of government, if it happens. When's your read on the election? When's it going to happen? I know you guys like this sort of stuff. You probably
key to forecasting everything, can forecast it often. So at the moment, the 18th or 19th of May, but the last period in May is most likely. We've got the Victorian election in a month. We've got the New South Wales state election in February. So it's technically they could hold it in March, and push the New South Wales election back. But they're most likely to try and run it out for as long as possible to get another budget in next year. You may have missed my EFO, but we follow that one closely. A reduction in the surplus. So the surplus looked like it was going to be $50 billion when Abbott first announced it back 4 years ago. It's now down to $10 billion, which means there's a reasonable chance that early next year they'll be able to announce that this budget's going to be in surplus. That's just the sort of thing that the coalition government would like to have heading into an election, to be able to announce a surplus and some income tax cuts or business tax cuts. So, May is our estimate.
And what happens, do you think, to building dynamics, investment in property? Should there be a change of government? And we're not pro any political party, we're pro property. So what would happen?
So the two aspects, population and tax. So if you look at population, certainly the coalition over the past 12 months have tightened up on net overseas migration, and that may be the end of that that cycle. There's quite evidently some political concerns, particularly coming from Sydney here with Bob Carr and Tony Abbott both raising from different perspectives congestion problems, either from an environmental perspective or from a crime perspective. And so, that's going to play out at the next election. And from our perspective, again, we're looking for stable immigration policies. The other is tax, and certainly changes to capital gains tax or an increase in capital gains tax. If there were a change of government, the Labor Party is likely to take that through to the next election. They had it the last one. If they do, I think it would be very opportune for them to pause and have a look at the reasons why they introduced that policy back 3 years ago when it was first announced, and how different the market is now, and what the challenges are in the market now are so fundamentally different that an increase in capital gains tax to slow investor activity in the market, that's already happened. It's been done, and they should really just take a little bit of time to consider whether that's the right policy for the market at the moment.
Well, let's keep chatting. You're Canberra-based, but when you're up this neck of the woods, let you back on and have a chat about. If I didn't know you and I ran into you in a barbecue, do you identify yourself as a economist or identify yourself as a gin distiller?
I'm a gin distiller moonlighting as an economist.
Very good.
6 or 7 days a week as an economist.
1 day a week as a gin distiller. How much time do you spend tinkering with gin stuff?
I've gotten out of it over the past 18 months. I now have a couple of other distillers.
Do the stuff.
Yeah. And it's been fun. I'm an economist first in terms of my skill set. My brain works that way. I've found myself in business, which has been a lesson and a ride because I did not anticipate it. I didn't have a business plan when I got going, and I pedalled flat out. So I've now got to myself to a point where I'm removed from those day-to-day operations, and it's a little bit of a relief.
Concentrate on the very, very important work you're doing with HIA, and that is giving us all the information we need to know in terms of mapping our housing industry, but also how that trickles down to every single part of Australia. I was quite surprised. 10% of people that work in construction. That's a big number.
That's a lot of high-vis shirts.
It's a lot of high-vis shirts. It's good. I drive around Sydney a lot, and the amount of infrastructure work going on here is just mad. Even like we're recording in North Sydney, there's high rises going up all over the joint, right? It's good times.
Yeah, well, that expectation when you go back a decade when they were planning those, that the belief amongst planners was that there was sufficient infrastructure in Sydney to be able to cope with that urban infill. And what we discovered pretty quickly was actually that infrastructure was A, a little bit aging, and B, probably pretty close to capacity already. And so now we're seeing that catch up, and it's unfortunate that it's happened that way around, but at least there has been the opportunity for some increase in density.
The way it works. So we'll keep following this. The challenge with being a property investor is that there is so much information you can pull out from all over the place and try and interpret it in a way and give you some sort of conclusion that you can use to shape the way you invest. A lot of this stuff is good to know. A lot of stuff you have no control over whatsoever, but it's good to be informed, and don't get overwhelmed by all this information though. So, just ensure you have the information you need to know in order to make informed investment decisions. And, it's tough sometimes to really crystallise what all this information means. My recommendation is don't try and do it all alone. There's some very capable people out there who can give you advice around how you should be investing in property, whether it's your broker, your buyer's agent, your accountant, whoever you're using. Lean on them. It's their job really to understand this stuff much more than you, and I do it very much as well. I'd speak to all these guys and say, what does this mean? How does it affect me? And often it doesn't really matter. Sometimes I need to know it. So speak with your advisors to make sure you're getting the information you need. Look, we've been covering quite a lot across the sort of economy, federal election, all this sort of things, but we also like to chat with investors. So if you're tuning in and you want to come on the show and you've heard my conversations with investors previously, just really good stories about what they're doing. So if that sounds like you want to come and share your story, contact the team, editor at smartpropertyinvestment.com.au. We'd love to have you on. There is literally a lot of people now listening to this podcast, and our objective is just to make sure we can shape this community and keep everyone better informed about what's going on so they can make better decisions in property. Remember, smartpropertyinvestment.com.au, everything you need to know about property. If you're not yet subscribing to our morning newsletter, so you're the first to know what's happening, smartpropertyinvestment.com.au/subscribe, or check us out on social media, Smart Property HQ. Lots of information there. I've probably overwhelmed you again. The stuff you need to know, smartpropertyinvestment.com.au. We'll be back again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.